Generation Trust is here, or Next Generation IRA Custodian. And so one of my favorite IRA custodians, and Jack's going to talk about how to self-direct your IRA, the costs involved, the process, and kind of what to expect when self-directing your IRA and that process involved. And then I'll talk about the real estate end of the business and how we help people invest in real estate and help people self-direct their IRA or solo 401k into apartment buildings in New Jersey. So Jack's going to speak for about 10 to 15 minutes and open up for questions. And then I'll speak for about 30 minutes and open up for questions. And we'll wrap up no later than 8 o'clock here tonight. So we are live on our Facebook page, Real Estate Investments. So you can also get the recording there. But without any further ado, Jack, why don't you take it away?
Thank you, Aaron. My name is Jack Malpass. I work for Next Generation, self-directed IRA company. I am in business development specialist here. We are based in Roseland, New Jersey. I just want to get the disclaimer out of the way that we are not fiduciaries or advisors, so we do not give advice on whether an investment is a good investment or a bad investment. We do educational sessions on whether it can be held in a self-directed IRA or not. So we are not fiduciaries nor advisors. And we just mostly for educational purposes. If you're interested in investment, it would be wise to consult a professional advisor on prior to making any investments. With that being said, what is a self-directed IRA and how is it different from your regular qualified retirement plan? A self-directed IRA allows you to invest in non-traditional assets. And what is a non-traditional asset? Non-traditional assets are assets that are not on the stock market. So your publicly traded stocks, bonds, mutual funds are all in your Edward Jones's accounts or Morgan Stanley accounts, and companies like that. Our company holds alternative assets. Anything that's not publicly traded on the stock market can be held in a self-directed IRA. The other things that cannot be held are life insurance, collectibles such as art or cars, and with our company right now, cannabis can't be held. So other than that, if you have an investment in mind that is not any of the publicly traded things I spoke about, our team would do a compliance on any investment to make sure that what you are looking to invest in can be held in a self-directed IRA. So with that being said, some of the possible investments you can invest in, one is like with what Aaron does is real estate, partnerships, joint ventures, syndications, mortgage notes, private placements, hedge funds, private stock, precious metals, joint ventures, crypto. So it's pretty unlimited here. The world is yours. There is no portfolio to choose from. Like with your Edward Joneses of the world or your Morgan Stanleys, they have a portfolio you choose from. The whole idea of self-directing means you go out, you look for the investment, you find the investment, and then you run the investment by us and we'll let you know if it can be held. So there's so many different options out there for you to look at. So that's what's pretty interesting about self-directing. So how it would work is however much your investment is, you would have to have some kind of qualified retirement plan, such as an IRA, a traditional or Roth, an old 401k plan, a SEP, a solo plan, HSA, ESA. As long as it's a qualified retirement plan, you can use that to invest into a self-directed IRA. The only other way you can put money into a self-directed IRA is through contribution levels. And depending on what type of IRA you're picking will depend on your contribution levels. So once your money is, however much your investment is, let's say you have it in a traditional and you want to invest, how much, Aaron, do you usually look for? 100,000? Let's
say 100,000, yeah. Mm-hmm.
Okay, so if you have an investment with Aaron about 100,000, you would have to liquidate 100,000 in your IRA. You would have to sell off your stocks, bonds, mutual funds, and put it into a cash position in your IRA. Now, you're not getting taxed on it because you're not moving it out. All you're doing is putting it into cash in your IRA. Once it's in cash in your IRA, then it can be moved to us because we don't hold stock. Okay. So once it's in cash, then you can move it to us. Opening an account takes about 1 to 2 days. Moving the money from wherever you have it to us is usually the longest period of time. Usually takes anywhere from 3 to 5 business days, depending on your institution. And then the compliance on the paperwork of the investment, whether it's the operating agreement, private placement, whatever your investment is, we would look at the investment docs to make sure that what you are doing can be held in a self-directed IRA. So you're looking at about 4 weeks to 5 weeks for your investment to be all the way through, opening your account, making your, putting your money into your account, and then making your investment. So that's the setup and process timeline. Now, with any type of real estate investments, there are IRS guidelines that you need to follow. You cannot buy a real estate property and live on that property. You cannot do any of the work on the property. You cannot have any ascendants or descendants living on the property. They are disqualified people. There is no commingling of money. You can partner with disqualified people, but you cannot commingle money. So that's very important to know that even though they are just your family members are disqualified from you, you can still partner with them, as long as the percentages of the deal stay the same way all the way through. If you're going into something with Aaron, again, you just need to make sure you have enough in there for your entire investment, because the only way you can put more money into your account is either through other qualified retirement money or through contribution levels. Okay. So if you were to jump on with Aaron and get on board with one of his investments, we work well with our Aaron, so we would already have the paperwork on the investment itself. So that kind of helps cut the timeline down a little bit. With something like Aaron or investments that are over $30,000, that's usually our cutoff line for our fees. Anything over 30,000 is most cost effective on our fee schedule with option 1, which is a flat base fee of $325 for the year, $25 for the application, which is done through DocuSign, and then $100 to move your money, whether it's to the investment or if you are looking to open an IRA LLC, we would move the money from the IRA down into your LLC. Speaking of which, LLCs, if you are looking to open an IRA LLC, you wouldn't have to have it done through an ERISA attorney, which there are a few on our website that you can contact. It doesn't necessarily have to be one of the ERISA attorneys on our website, but if you're looking to do an IRA LLC where you have checkbook control, it would have to be set up by a specialized attorney called an ERISA attorney. That's ERISA. And again, if you're looking to do that, or you need additional information, Aaron was going to give you my phone number, my contact information, and we could discuss it further. So that's pretty much how it works in a self-directed IRA. It's great for people who want to do alternative investing or are looking for a tax advantage account. Instead of using personal cash where they're not getting the tax advantage, they can use their retirement money, qualified retirement money, to gain the tax advantages of that kind of account. So that's pretty much how it works. Again, if you have any questions, please reach out to me, and I can walk you through the whole process. And I think that's just about it, Aaron. If I've missed anything or anything pertinent information you think I should let them know about.
No, that's great. That's great. So yeah, we went over the cost there. And so yeah, it makes more sense to do the second fee structure. And then, so if you have more than $30,000, what was the second fee structure?
The fee structure for under 30,000 is more of a quarterly rate.
Mm-hmm.
It's a value based on the asset itself.
Mm-hmm.
So it's structured, $0 to $1,000, $1,000 to $2,000. So all depending on how much you're investing, there's a quarterly chart on how much you'll pay. So that's why 30,000 is usually a cutoff line. Where so because some people do crypto and they do less than 30,000. So paying $325 a year wouldn't be more cost effective if they were investing less than 30,000. So
I really wish I invested less than $30,000 in crypto. I really, really wish I invested less. But hey, you live and you learn. Should have stuck with real estate.
Oh, there are other things that are less than, that people don't need to invest $100,000 in.
Yeah.
So some people do crypto, precious metals. They pick out. There's all different things they can do, and you could even be a lender. You can lend money to friends and be a private lender. So and make up a promissory note. You can, startup companies. A lot of people invest in startup companies that don't need a whole lot of money to do. So it's unlimited on what you can come up with. So
that's what Peter Thiel did with his IRA. He invested in Facebook, right?
There you go. Yep. So
PayPal. Yeah.
And then you had Mitt Romney, who invested in his own company before, when this all started. He started, and that's how he made his millions, using a self-directed IRA.
Wow.
And so he invested. So it's just mind-boggling what you could do if you just think about it and put your mind to it.
Maybe I'll get Mitt Romney on the webinar next month.
There you go. or the guy from PayPal.
Let's see what he's up to. I'll make a few calls. Yes.
There you go.
Excellent. All right. Very good. Well, thank you, Jack. So yeah, if we have any questions as we go along here, please type them in the Q&A. So there's also a chat as well. But Jack, why don't you go ahead and write your contact information in the chat? You should be able to do that. Yes, you should be able to type that right in the chat. Just make sure you send it to the host and the panel, or everyone. Click everyone. Okay. So you can send it to everyone on the chat. Okay. And so that way everyone can have your contact information there. Of course, it's Next Generation out of Morristown, New Jersey.
No, Roseland.
Sorry, Roseland. You guys, I think at one point you had an office in Morristown, right? A while ago? No? Okay. Roseland. Okay. Got to get my IRA custodian straight here. Man. I swear, Jack, I don't hang out with any other IRA custodian.
Okay, Aaron.
All right, I swear.
Okay.
I don't know what that perfume smell is. All right. Oh, we have a question here. I don't know if you could see it from Frida here. We have, my IRA is managed by Raymond James. Can I turn it into a self-directed IRA?
Of course you can. Yes. Whether it's a traditional or a Roth, you can turn it into a self-directed IRA. Yes, you can.
Excellent. Yeah, that's the whole name of the game. That's the whole thing. A lot of people, have their IRA with a Fidelity or, wherever most people keep their IRA, and they have no idea that you can actually self-direct it out of the stock market and take control of your IRA. Because if you ask Fidelity that, or Raymond James, they're going to be like, no, you can't do that. No, you got to leave your IRA here. Or that'd be like, that's not a smart thing to do. Self-directing your IRA inherits risk, and you don't know what you're doing, and you're not smart enough to do that yourself. So just keep it here, and we'll tell you what to do. And listen, there's a benefit to keeping your IRA somewhat with a large scale, stock investment company. You want to diversify some, ideally, into alternative investments. And Frida has another question here. Are there penalties for self-directing your IRA, or Jack?
No, there's no penalty, because you're moving it from one qualified retirement plan to another. So if depending on if you have a traditional IRA or a Roth or a SEP, as long as you're transferring it to a qualified retirement plan, whether you're doing a traditional to a traditional, a Roth to a Roth, there's no penalties, because all you're doing is taking it from one retirement plan to another. So no, there's no penalties. Also, if your investment is, let's say you have 500,000 sitting in an IRA, and you're going to invest 100,000 into Aaron's, one of his investments, you're not going to liquidate your whole 500,000. All you're doing is moving the amount you need for your investment. So if the investment's 100,000, you might want to move like 105 or 10, just in case for fees or one of Aaron's roofs blows off and he needs a little more money.
That's called a cash call, and we've
Yes.
never done that. We've never done
Okay.
a cash call for the record.
Okay. So you might just want to throw a little extra in there, but you're not blowing up your whole IRA. All you're doing is moving the amount you need for your investment. So, and no, there are no penalties. The only penalties are if you take it out and you hold it and keep it yourself and don't put it anywhere into a retirement plan, then your penalties are pretty stiff, especially if you're under 59 and a half.
Yeah, as long as you're working with the middleman, the IRA custodian here, that's Next Generation, then you move it from, Raymond James, you contact, first you contact Next Generation, you set up an account, then they're going to contact Raymond James for the amount you're looking to move over. At that point, the funds will be moved over. Generally, it takes about 1 to 2 weeks. I've seen it. It kind of depends on where the funds are held, but for the most part, they have to move the money. It's your money, it's your IRA. So once you sign up with your IRA custodian, they'll contact whoever holds your IRA. They'll move over the proper amount. And then once it's with the IRA custodian, Next Generation is actually really quick. I've worked with probably 15 different IRA custodians, and they are one of the best. That's why I have them on here. So they're very quick. They're very affordable. I think their fees are less than a lot of their competitors. So I like how you're local too. To us, that's nice. People like that as well. Yeah, definitely a good company. Okay, good. So it looks like Frida there is excited about self-directing IRA. Very good. All right, so Jack, your information's in the chat there. So reach out to Jack at nextgenerationtrust.com, and there's his number 973-533-1880, extension 128. So that'll be in the chat. We'll leave that up, and you can always email us as well after the webinar, infopeoplescapitalgroup.com, and we can always connect with Jack as well. And but yes, that is the process of self-directing your IRA. So once you select your IRA custodian and move your IRA over, then you have to decide what to do with that IRA. Ideally, you've already decided, of course, before you're moving your IRA. Usually you find the investment, say, oh, I like that investment. I want to invest in that. I want to do more with my IRA. And then you'll select your IRA custodian and move it over. But it may make sense to, start moving your IRA sooner than later if you do want to do something with it. Because I have run into investors that are kind of behind the curve, and then maybe the investment's wrapping up and they only have a certain amount of weeks to get the investment together, and it's not enough time for them. So if you are looking to self-direct your IRA into real estate, it's good to get it going sooner than later. And all right, Jack, anything else to add here?
Well, I think we're good for now, Aaron. I think I pretty much covered it. If anybody has any questions or want to throw an investment by my to see if it can be held in a self-directed IRA, please, you have my name, you have my number, reach out.
Great. All right. Awesome, Jack. Thank you so much. I'm going to jump into my presentation here about how to self-direct your IRA into real estate. And we're going to get started here. All right. Quick disclaimer, not a solicitation for funds, tax advice, or legal advice. Well, our mission tonight is to transform personal finances and quality of life by creating passive income streams through real estate investments. So Seth and I started this company almost 10 years ago, and we've helped nearly 100 people diversify into real estate, whether it's through a self-directed IRA or a solo 401k, or just investing cash as well. About a third of our investors use self-directed IRAs or solo 401ks. So we're a very popular option for self-directed IRAs. And Jack explained the process of selecting your IRA custodian and teaming up with them and hiring them, and then moving the capital to the custodian, then into an investment. Of course, once the investment is created on our end, those cash flow checks go back to the IRA custodian, and the big lump sum upon the refinance goes back to the IRA custodian, so you can build that IRA much faster. And we're going to talk about how we buy, renovate, refinance apartment buildings tonight, what that means, why it's a smart way to invest in real estate, in our opinion, and why we focus on the New Jersey market, and how we've helped people invest in apartment buildings in New Jersey here for years, and why that's a really solid, tried and true investment as the stock market kind of tumbles these recent weeks. We do see the real estate market, apartment buildings with value add opportunity as a tried and true investment. So we'll break into that, why we feel it's a bit of a recession proof investment, or recession resilient, we like to say, investment option as compared to the stock market, and a good reason to diversify some capital of your IRA out of the stock market and into professionally managed real estate through a real estate syndicate. And that's what we are, real estate syndication. That's what we're known as. So I read a book called Rich Dad Poor Dad about 12 years ago, and that sparked my passion for real estate, and sparked also our business model here of the buy, renovate, refinance strategy and using debt to pay yourself. And that book teaches the moment you make passive income and portfolio income a part of your life will change. Robert Kiyosaki, there's the author. So Seth and I love that book, Rich Dad Poor Dad. If you haven't read that, pick it up. It explains how billionaires pay themselves, how the top wealthiest pay themselves. And it's through refinance of high quality assets, like a strong piece of real estate, commercial real estate, or good businesses that produce a lot of income. And we're going to talk about how paying yourself through the refinance of assets tonight is the best way to pay yourself for tax purposes and just for reasons to build wealth over time. And we'll go over some case studies about some buildings we bought with investors and how we've really been able to hit far better than targeted and just do very well in this market with our in-house management company, and why we've structured that type of business. So a little bit about People's Capital Group here. Seth Martinez on the left, that's me on the right. We own People's Capital Group 50-50. Seth is primarily in charge of operations, managing our management company, doing due diligence on the initial properties we're looking at. I'm more in charge of client relations, fundraising, marketing, branding. I do a weekly podcast. I do webinars twice a month. We have in-office events about every 3 months, and we have blogs on our website every week as well. So put out a ton of content. We don't sell coaching or boot camps. We aren't the rah-rah guys. We just help people invest in real estate. We've been doing this 10 years, and we have an in-house management company out of Berkeley Heights, New Jersey. So Seth and I have done over 250 real estate transactions together. We're about a $20 million portfolio right now, about 150 doors, and dozens of investors that reinvest over time. So here's our agenda. Number one, why do people invest in apartment buildings in New Jersey? Number two, why do people prefer a syndicated investment? That's when we pool capital together. It allows investors to get on larger buildings, and bigger is better in real estate. We'll go over that and explain that. Number three, why do people value PCG's service? So we create a nice turnkey opportunity to invest in a high demand market, and a market that's pretty hard to get into in North Jersey here. So we'll talk about how we snag good deals and present those to our investors and make it easy to invest in real estate as long as you're qualified, and there's a qualification process, which we'll touch on. So why do investors like New Jersey? Well, wages have rose here. Rents continue to rise. We've seen incredible growth in property values that we've seen throughout the country, but there's just not enough housing in New Jersey. And we're seeing that in many parts of the country these days, but especially New Jersey, New York, this market is crazy. If you tried to buy a single family home recently, you've probably been outbid. Even with rates going up, the demand is still extremely high. See, they just haven't built enough real estate in the last 10 years, especially in New Jersey here. So there's so many people living here, even with the pandemic and people kind of moving out of the city. A lot of them moved to Jersey. A lot of them really like the Four Seasons, like living here. And it does have a high cost of living. There is red tape you have to navigate through as a landlord. But if you know how to navigate the red tape, you know how to find the great deals, New Jersey is a wealth of opportunity. And we have lines out the door to rent our units. The hardest part is finding a good deal. So we rank very high in the workforce, number one in education, number three in household income, 20 Fortune 500 companies, number one in drugs and pharmaceutical jobs, number two in direct foreign investment. So really popular state here, a lot of big business hub in New Jersey. We don't do Manhattan. We really focus on the North and Central Jersey markets here. And that's been a nice recipe for our investor group for the last decade. So why do people invest in New Jersey apartment buildings? Well, they want legal tax shelters and predictable investment returns to confidently fund important occasions in life. Right? One of the most important things about your 401k or IRA is that you want to make sure it's worth more in the future, but you also want to make sure that it's still going to be there, right? You want to be in a solid investment. And that's why a lot of IRA custodians or financial advisors will say, well, don't put all your money in crypto, right? Because that's a high risk, high reward investment. Real estate's kind of on the other end of the spectrum with a lower risk, ideally low reward investment, although we've been able to get really solid returns with our buildings. We'll go through how we do that in our process here. But IRAs and 401ks are for long-term investments, a long-term strategy. Generally, you're looking at a 10, 20, 30, 40-year window. You're planning your investment out with. And by investing in high demand real estate here in North Jersey, we've seen the demand hold through recession. We've seen the demand hold through thick and thin. And there's so much demand in this market that you just haven't been building enough. And it's going to take a while, even if they start building a lot, which they're really not doing, to catch up to the demand right now. So we see huge amount of demands, low supply, and that keeps our values strong here. That keeps our rent roll strong as well. So we see low risk investments here in New Jersey, and with larger properties, more units under one roof, our vacancies hinder us less and our repairs hinder us less. So if you have a 2-unit apartment building, a 2-unit duplex, and you lose one of your tenants, well, you're gonna have trouble paying your mortgage and costs. If you're invested in a 25-unit or 50-unit or 100-unit complex, now all of a sudden covering those costs is very easy if you lose a few tenants or there's a big expense and the boiler breaks. So covering those expenses, covering the cost of vacancies is easier on larger properties. More units under one roof gives you economies of scale in real estate. And that's why bigger is better. And that's why we focus on pooling capital to buy larger properties. We also like buying near New York City. We're also now investing in Trenton as well. We're opening up there. We're buying a large building in Trenton that will be opening up to our qualified investor group in the next 30 days or so. But again, so the main reason we like apartment buildings here for 401ks and IRAs is because it's a more predictable investment return over time. We know people are going to need a roof over their head. We know the construction strategy we're going to do, the improvements we're going to make to the building to force equity into it. We know what units are renting for already in that area. So it's a more predictable investment ideally than the stock market. And that's why people do diversify about 30 to 50% of their IRA into real estate. We see that as a common move. About 30 to 50% of individuals' IRAs do move into real estate through self-directed IRA custodians like Next Generation. And that's a good way to diversify some of your IRA into tried and true professionally managed real estate. And well-managed apartment buildings do tend to fare well in recession, keep more predictable cash flow coming in. There's also tax depreciation to lower the tax burden of other forms of income. Of course, with your IRA, that's more of a wash because you're tax deferred regardless. So of course, people want legal tax shelters, as we were saying, to fund important occasions in life. So weddings, putting your kids through college, vacation. The idea of real estate is it's a very high demand asset class, but it's also a very management intensive asset class. So it's not realistic for someone to buy a $5 million apartment building and manage it themselves, or even manage a management company, reposition the building and remove non-paying tenants, renovate units, lease them out for top dollar, make sure your management company is doing everything they need to do, make sure that costs are lower, get tax abatements done, and get tax reassessments done. All the things we do to increase our revenue on the buildings, lower our cost, increase the value of the building, and eventually achieve a cash out refinance, which I'll explain in this presentation. All those moving pieces, it's a ton of work. We have a full-time staff. We have, Seth and I are managing our people all the time. It's really a very busy job. So the idea of a real estate syndication is all that is done for you. And you're investing as a passive investor. You enjoy monthly updates, quarterly financials, quarterly cash flow checks as the building makes positive cash flow, and big lump sums upon the refinance. So it's a completely passive investment. And that's what real estate syndication is. So we're pooling capital together. You're essentially hiring professionals to do the work for you, to find a great opportunity, to manage the management company for indefinitely through the entirety of the project, to manage the contractors, make sure renovations are done on time and on budget, and do all these things it takes to make the building perform. You're essentially hiring those individuals when you invest in a real estate syndicate like People's Capital Group. And that's a smart way to invest when getting into an asset class, is by hiring professionals and teaming up with people who are experienced and have already made their mistakes and built their infrastructure in place. And it's taken us a good 10 years to do this. And we've developed a company that's focused on repositioning apartment buildings, buying mismanaged apartment buildings and making them perform better. So we look for larger units under one roof. So ideally bigger is better in real estate. So vacancies hinder us less. We also sign for the mortgage so our investors don't have to, right? If you're buying a building yourself, you're personally guaranteeing the mortgage. We do that so our investors don't have to. We make sure our investors are not involved with the mortgage or the debt in any way and are simply limited to their investment risk. So at the end of the day, we take out as much risk as possible and we try to make it as easy as possible to invest in kind of complex opportunities, mismanaged apartment buildings where we're doing all these moving pieces behind the scenes to make it a performing asset. I mean, it's not rocket science, but there's a lot of moving pieces. So, we try to make it easy to understand, easy for people to digest the opportunity, understand what we're doing. Our monthly updates are in depth, but they also teach people what we're doing. And a lot of our investors say they learn and earn through investing with us, which is really a compliment because I try to really educate our investors along the way. Although, of course, we don't sell coaching or boot camps or anything like that. We just focus on explaining to investors what's going on with the building, the good, the bad, the ugly, how we're solving those problems, and how we're making the building work for our investor group. So we focus on areas like Newark, Patterson, Trenton right now, Plainfield. We just bought a 27 unit in Rahway, New Jersey. We've done well in inner city areas. We really have understood how to buy these mismanaged buildings, sometimes owned by a slumlord, and we're coming in and we're able to really go with our best foot forward. See, a happy tenant equals a happy investor. So we understand that people are living in units sometimes that are really not taken care of. We'll fix up the unit, renegotiate a proper lease, or maybe they're just not happy there and we'll work out a cash for keys where we're paying a tenant to move out. That's an amicable exit for the tenant. It helps them have their moving costs covered. And by having that unit then vacant, we can renovate it and release it for top dollar. Other times we're also ending up in eviction court with non-cooperative tenants. So there's a lot of different ways to turn over units, renovate units, and we try to do the amicable way. We try to be as friendly as possible and really team up with our tenants. If they can't pay, we work out payment plans. If we do want them to exit the unit, we'll work on an amicable agreement, generally with a cash for keys or just a timeline that works for them. And we really understand that treating our tenants right is going to lead to a happy investor. So a happy tenant equals a happy investor, because happy tenants that are treated well and respected are going to pay their rent on time and take care of the unit and be happy to live there and stay there longer and invite their friends over to rent out units as well. So good tenants attract good tenants. Good tenants equal happy investors. And we treat our contractors, our garbage professionals, our $1 million investors, all the same way, with respect and courtesy and professionalism, same way I treat Jack and everyone we do business with. And we find that's the best way to do business, no matter who you are, whether you're investing $1 million with us or renting a $1,200 apartment from us. So we really find our best foot forward with the tenants, and that helps create a working environment in the building. Okay, so number two, why do people prefer syndicated investing? Well, quite frankly, they don't want to manage the property, right? It's a very management intensive assets. We have an in-house management company. We take care of everything from A to Z. It's 100% passive investment with monthly updates and quarterly financials. By pooling capital together, people can get invested into multi-million-dollar buildings with as little as $30,000. And we've helped sophisticated investors and accredited investors, and I'll break into that, but that essentially means multi-million-dollar investors that are accredited, and sophisticated investors, the SEC explains, as people with investment experience, but they're not yet millionaires, they're not yet accredited. So we accept both smaller investors and larger investors, where most real estate syndications only accept larger accredited investors, essentially millionaires. So we accept both smaller, sophisticated investors and accredited investors. So we really open the door to all different types of people. That's why we're People's Capital Group. We help people invest in real estate. So people like the idea of tapping into expert real estate knowledge, being lifted up above the pitfalls. Again, Seth and I have been doing this for 10 years now, building our management company in place, building relationships with brokers and wholesalers and landlords to find deals. So acquiring this expertise has taken years. And people value their free time and have no interest in securing complex financing or dealing with the shenanigans of being a landlord. It's really not a very fun job being a landlord. It's a bit thankless if you do it right. then that's, really, your tenants are like, great, thanks for paying the rent. No, it's, it's a job that you have to work every day at. And property management is very intensive. So once we buy the property, what do? Okay, so we've executed, then we have a value add strategy on the building. That means we're going to renovate a common area. We're going to renovate the exterior commonly. We're going to renovate the curb appearance of the property. So when you pull up to it, it seems like a nice, safe place to live. We're going to renovate the units. One thing we did on our building in Rahway recently was we put in motion controlled sinks. So when you wave your hand over the kitchen sink, it turns on. It's really nice. It's really luxurious. It's something that you find in like $1 million homes. And we put them in $1,100 studios. So, now that's going to really pop. And now all of a sudden that $1,100 studio is worth $1,150 because it's just that really nice little difference. And it gets rented much faster, or it attracts that better tenant. So we're seeing, by doing little differences that make big differences in our buildings, that's really how we improve these buildings to a T. And we don't always break the bank either, right? The goal is to not break the bank, spend as little as possible. That faucet probably cost me maybe $80 more than your average nice kitchen faucet. But at the end of the day, it's going to allow me to gain that back and rent tenfold per year. So really can be incredible. Return on investment if done properly, renovation of apartment buildings, leasing to high quality tenants, making a building that kind of attracted a certain quality of tenant now attract a better quality tenant, make it a nicer place to live, more confident bringing your friends and family over there. That's called forcing value into the property by doing physical renovations of the property, making it a better cash flowing asset and leasing it to more quality tenants as well. And that allows us to do a cash out refinance. Okay, so we buy the building for a discounted price, we renovate it on budget, and then the building's worth a lot more money. You see, because the more a building makes, the more it's worth. Commercial real estate is valued based on its net operating income and a cap rate. So the more net operating income we can create from the buildings, the more the building will appraise for. So as we increase that net operating income, we increase the value of the property. That allows us to do a cash out refinance, which I'll break out in the next few slides. But to find the deals, it's a ton of work behind the scenes. We'll invest up to $10,000 a month sometimes in marketing. We'll look at 400 deals just to close on one. We have over 10,000 people in our network between investors and landlords and realtors and brokers and people we've been dealing with for years. We have 4,000 people in our meetup groups. Just a nice large network. Seth and I have experience in fixing, flipping homes, wholesaling real estate, buying and selling apartment buildings, buying and refinancing apartment buildings, doing all the above with multifamily and single family as well. So a nice breadth of experience as well in these markets, all in the North Jersey markets and Central Jersey markets. So we're really laser focused on this market, and that's what our investor group likes about us as well. So together, we've done over 250 transactions, totaling over $40 million or so in assets. Right now, we have about a $20 million portfolio, about 150 doors over North and Central Jersey. Again, we focus on securing good financing, personally guaranteeing the debt sometimes, and that makes us hyper vigilant on the finances to make sure we hit our marks on our reposition and, of course, get good terms on that debt as well. So number 3, why do people value PCG's service? So we've created an aggressive calculated business model over the last decade, and it's been tough, developing a good management company that buys mismanaged apartment buildings. And these apartment buildings take a lot more heavy lifting. See, we had 3 management companies before this. We had hired and fired 3 different management companies. And we said, hey, we want you to, take this building, renovate units, release for top dollar, keep costs low, evict non-paying tenants, work out deals with other tenants. And they said, no, we just want to collect the rent when it's due and call a plumber when the pipe leaks and, collect our 8%. And we said, well, that's not what repositioning apartment buildings is. So we realized if you really want to reposition buildings, you actually need to own your own management company to do it the right way. Most real estate syndications will pool capital in an area like New Jersey, New York, and buy properties 5 or 6 states away in emerging markets and hire a third-party management company. To me, that's a great flaw in the syndication space. I feel like if I'm putting my reputation on the line, I'm telling you we're going to achieve something. I want my company to manage the property to make sure we achieve that. It's a lot different when your staff is managing the property than some third-party service provider. You can't necessarily, get as much control with that. I've also found management companies can lie to you. Surprise, surprise. So we developed our own management company. We also work with a whole third-party CPA accounting firm that does all of our bookkeeping and tax prep, act as our CFO for the company as well. Nice separation of powers with two different companies there. So we have an in-house management company and we have a third-party accounting firm we work with that does all of our bookkeeping and tax prep, which is part of property management as well. So we'll market over every month here. We'll cherry pick the best deals after spending up to $10,000 a month in marketing, sometimes looking at hundreds of properties. We want to find the deals with forced equity, with value add opportunity, rents below market value, renovations to be made to the property, room to increase leases, nice locations, high demand markets in North Jersey. And then we'll pool capital together. We'll buy that investment. Some investors come in with as little as $30,000. Other people have seven figures with us. We help sophisticated and accredited investors, people getting started and people very experienced in real estate. And so we'll pool the capital together, shift the risk out amongst many investors, and then we'll create passive income from that property through cash flow. And we'll execute a refinance about 3 to 5 years into the investment that we try to achieve about half of the investors' investment back upon the refinance. Right now, we're refinancing an 11 unit in Patterson, for example, and we bought 3 years ago. And we're refinancing it, and the investors are getting back about half their investment at the 3-year mark. Now, we didn't target that. We targeted this would happen over a 5-year period, but we executed very well on our end with our in-house management company, and the market's been the wind on our sails. The market's been very good. That's allowed us to achieve this cash out refinance 2 years ahead of schedule. So right now we're achieving returns 30–40% greater than targeted. So really an incredible market right now, incredible performance of our fund, and just a good testament to our infrastructure, but also how good the real estate market has been and how good we buy properties for as well. You got to buy for the right price also. But let's go over the cash out refinance, the power of forced equity appreciation. So once we cherry pick that property after looking at 400 different bad deals, we'll find the best deal. We want to increase the net cash flow by doing all those things I just explained: renovations, releasing, improved management. We're going to then increase the cash flow, increase the property value by increasing that net cash flow. As our property value increases, our equity will increase. That's the difference between what you owe on the property, the debt, and what the property is worth. As our equity increases, we can increase the cash due from the refinance, and we'll complete that cash out refinance 3 to 5 years into the investment. And that allows for a nice tax-free payout to investors. And the less tax you pay, of course, the more you earn on your investment, the better your IRR is, your internal rate of return, and your return on investment, your ROI. So why is a cash out refinance tax-free? Well, first of all, if you do it with your IRA, it's tax deferred. So that's a huge benefit. But let's say you're investing cash and you in the property, and let's say you made a $100,000 investment in the property. We got the cash out refinance after, say, 4 years, and now you expect about $50,000 back on your investment. So at that time, you have the option to exit, get back your initial $100,000 investment, keep the $50,000 earned from the refinance, keep the cash flow earned from the property as well through that time period, and exit the investment. But now the IRS is going to say, well, wait a minute, you just invested $100,000 in People's Capital Group, and now you're walking away with 160, say, between the refinance and the cash flow. So you made a 60% return on investment over a 4-year period. So now you have to pay capital gains tax on those earnings because you exited the investment. So the better tax strategy is to stay invested in the building. We'll do another cash out refinance 3 to 5 years down the road, probably another one around year 12 to 15, and eventually sell the property through a 1031 tax deference, trade into a bigger property. Bigger is better in real estate, produces more cash flow, larger cash out refinances, and that's a 1031 tax deference where you sell the building, defer all taxes, and trade into a bigger property. That's a whole other presentation, but that's a great tool to harvest your equity growth, sell the building, move into a bigger property, and defer all taxes. So you could do that whether you're invested with cash or an IRA. It's a great way to stay invested long-term, build your wealth indefinitely. And that's our strategy. And that's why a lot of people like us for IRAs. because the idea is it's a long-term investment strategy, and that really does work for IRAs and solo 401ks. So as we complete this cash out refinance, the investors, of course, have that exit option. Now, if you're using a self-directed IRA, the exit option is tax deferred. So you would defer those capital gains tax. And that's the whole idea of using a self-directed IRA, to defer those capital gains. If you invest with cash, you would owe those capital gains upon exiting. So of course, a better strategy is to stay invested long-term. Also, once the building's up and running, we've done all our repositioning, it's a nicely run asset, it makes sense to stay invested long-term as well, because the heavy lifting is kind of done at that point. So 90% of our investors stay invested long-term. So, okay, so we create passive income streams. So PCG manages the property with an exit strategy in mind. We have an aggressive and successful repositioning track record. We've created 9 different funds. We've closed out a number of them, all of them successfully hitting target. We have low vacancy rates, high collection rates, generally around 97 and 98% collection rates on our properties, with exceptional tenant care, putting our best foot forward to take care of our tenants first. A happy tenant equals a happy investor. And, we calculate the construction costs to stay on budget. That's important. Of course, you want to make sure that you have room in there in the construction. We've been doing this long enough to know you want to have a little extra room in the construction budget. And we only manage our own properties, so we're laser focused on our own assets to create consistent cash flow and a real true passive income stream through real estate with an exit strategy in mind. So to reiterate the exit strategy here, we'll go over that one more time. It's quite simple. Every 3 to 5 years, we do a refinance. You can stay invested in the LLC, continue to earn passive income from the cash flow. The refinances every 3 to 5 years, or you can exit at any of the refinances, sell your ownership of the LLC. You would keep the funds earned from the refinance, keep the funds earned from cash flow, but of course, if you're not invested with an IRA, there'll be tax consequences. If you are invested with an IRA, it's tax deferred. So we keep it quite simple. You can exit at any of the refinances and get back your initial investment, or stay invested, hold your ownership in the property, and continue to earn from that property. Most investors choose the second option. So to date, we've pulled about a $7.5 million or so in capital, and we have a minimum investment around $30,000. It's about a 3 to 5 year investment period. So it is a longer term investment, to keep that in mind, which is great for IRAs. And People's Capital Group, we evaluate investors to make sure they're a good fit. We have over 55 investors in our network here actively investing with us. We've helped over 100 people reinvest through the years as well. And we actually continue to build out as well, working with different groups of doctors and things like that, different investment groups these days as well. And we'll get a mortgage on the property as well. Usually 70-75% of the purchase price will be leveraged. So we leverage that investor's capital. That helps them earn better returns on the investment, and ideally continue to cash flow on properties indefinitely through cash flow and refinances. So let's do a couple case studies here. We'll wrap up for the evening. We'll also open up to questions. Again, if you have any questions as we go along, please put them in the Q&A. I encourage questions. Here's an older property we did a while ago. It's a smaller property, but I like to do this case study because it's such a good investment. It was a small 5-unit we bought in Newark, New Jersey, near Rutgers University. We paid $110,000 for the property. They were asking $130,000. So just great. We really stole this property. I couldn't believe how cheap real estate was going back then as well. And we captured a nice $20,000 in equity off the bat. We put a small amount of renovations into it, $30,000 to $50,000, and it appraised for $310,000 just 1 year later. So bought it in 2013. We refinanced it in 2014. Bought it for $110,000. It appraised for $310,000. We were probably into it for maybe another $70,000, say between holding costs and acquisition costs, and renovation costs. So let's say we're into it for even $200,000, appraised for $310,000. So we were able to pull out 75% of that, pay back the investor's entire investment. We had a different structure this time. We then resorted to an 80-20 split, with the investor earning 20%, the owner, PCG, owning 80% after the refinance, after the investor got his entire investment back. So now with apartment buildings, we tend to do about a 70-30 split, with People's Capital Group owning 30% and our private investors owning around 70%. This was a little different structure here. We refinanced again in 2017, paying out even more capital to our investor there. And the property continues to produce a little bit of cash flow and tax depreciation for the investor. So just a really successful refinance there over time, multiple times, making really good return on investment for that investor very quickly. Here's a bigger property to explain a little bit more what we're focusing on these days. Here's a 25 unit in Paulsboro, New Jersey. This is actually in South Jersey. We bought and sold over about a 2.5-year period. So they were asking 1.2 million. We paid $1,075,000 for it. We captured $125,000 in equity right off the bat. It's important we get a discounted price on the real estate. That's our job, to bring a nice discounted opportunity to our investor group. We secured a bank loan at 75% of the purchase price at a 4.5% interest rate. We had 4 investors come in with $100,000 each. It's not always that clean. Sometimes we have investors at $30,000, other investors at $500,000. So obviously, the more you invest, the more equity is owned. There's also an incentive to invest a higher amount as well. But in this case, we had 4 investors come in at $100,000 each. We did an equity split of 60% to the investors, 40% to People's Capital Group. And we sold the building 2.5 years later for $1.35 million. Made a nice profit of 24 to 26% for our investors there. So we achieved a few ticks above targeted investment. We made about a 10.5% return on investment annualized for our investors here. We targeted about a 10, so we did a little better than planned. And right now we're hitting about a 15% annualized return on investment for our investor group. That's not what we initially target, but that's what we're achieving in our current investors. And that's a nice, solid cash on cash return, a 15% annualized cash on cash return. That means a $100,000 investment would earn $15,000 when broken out annually on the investment. Okay, so that's per year when broken out annually. So nice solid return on investment. Now we don't target that large a return on investment. We target more of a 10 to 11% for our investor group, but we'd like to under promise and over deliver. And that's why the majority of our investors reinvest over time. So investing with your IRA, Jack touched on this. I'm not going to reiterate it too much here. We're going to just wrap up over the next few slides here. So self-directing your IRA into real estate is a very popular option for us because we have that long-term view of real estate. See, most real estate syndications are going to buy and sell an apartment building in about a 5-year period. That we don't like that strategy because then you lose your cash flow asset, your tax depreciation machine, so your equity growth machine, right? Your refinance capital. So when you sell the building, you have to pay capital gains if you're invested through cash. If you're invested through an IRA, you can defer those gains. But if you hold on to the building long term, it could be the gift that keeps on giving and keeps building your IRA, especially if you trade into a bigger property over time through 1031 tax deference. So a lot of people have put their IRA with us and built it over the years. We work with tons of IRA custodians. Next Generation Trust is a great one to team up with. And we make the process very easy. We're very IRA friendly. We know the documents they're looking for. We know how to structure the operating agreement, so it's going to be approved by your IRA custodian. And we know how to guide you in the process and also kind of guide your IRA custodian as well. If you already have one, we can kind of teach them how to do what we do as well and make it easy to invest with us as well. But teaming up with Next Generation would be easier because they already know our business model, they know our documents, and they're already kind of pre-approved there as well. So very easy to self-direct your IRA. You select the custodian, move it on over once you select your start your account there, and then move it into the real estate syndication. We'll send the K-1 tax form to your IRA custodian every year. We'll send the cash flow checks back to your IRA custodian every year. We'll send that lump sum upon the refinance back to your IRA custodian, and it's going to build your IRA account. It's not a way to pull from your IRA early or anything like that, but it is a way to build your IRA more aggressively in an asset class that's truly diversified outside of the stock market. It's not a REIT, it's not a stock backed by real estate. We actually offer true ownership of high demand, professionally managed real estate. We also make tax time easy by issuing the K-1s very quickly. As I said, we work with a whole third party bookkeeping, accounting, tax firm that does all of our tax prep, all of our bookkeeping to make sure that there's a nice separation of powers there and that it's done properly and effectively by professionals that do bookkeeping and tax prep. So over the years, we've satisfied many investors here. Here's a couple feedback from different investors. Tim Carey, 5-time investor. I continue to grow my investing relationship with People's Capital Group. They have a great history of buying properties at a good price and offering value. Frank Pacuzzi, 4-time investor. My investments have been on point. I like not having to manage the properties. Chris Salerno, 6-time investor. I've been investing in people's capital group for nearly 5 years now and cannot be happier with the process and the returns on my investment. Aaron and Seth and the rest of the crew are fantastic to work with. They're like clockwork in their updates, communications, and payments. A great company. So we really strive to impress our investors, hit way above those terms, under promise and over deliver. And our monthly updates are just really appreciated because they're very in-depth with pictures and videos and information on what we do. So it's really important that if you're ever teaming up with real estate syndication, ask how many of their investors reinvest over time and what type of communication do you get as well, because communication is everything. A couple types of investors we prefer to work with are accredited investors. Of course, we like accredited investors, high income investors. These are individuals who tend to have large stock portfolios and are getting stock dividends. Well, cash flow is similar to that. So with real estate ownership of a syndication, cash flow is comparable to the stock dividend, although cash flow can be written off with a tax depreciation. Of course, if it's through an IRA, it's tax deferred regardless. Also, long-term returns are a little more predictable with real estate. We feel that it's more recession resilient as well compared to the stock market. We also work with active real estate investors. Maybe you own a piece of real estate already. Maybe you're collecting rent from your tenants and it's kind of a headache, or you're just having trouble finding your next deal and you just can't find a deal that makes sense and get the returns you're looking for. Well, we work with a lot of active real estate investors that are able to invest passively with us and make similar returns to what they earned actively investing, but of course, not having to do any of the heavy lifting behind the scenes. So they like not being on call. They like the syndication model because they don't have to take on the mortgage risk where we personally guarantee the debt instead of them. They not like having to manage the asset day in and day out and getting into a bigger building with a smaller investment because more units is better return, less risk, and a better refinance cash out. Also, like tax time, because we make tax time as easy as possible and as painless as possible for our investors. So the third type of investor we like is an IRA investor, right? Self-directing your IRA or solo 401k into real estate. These tend to be sophisticated investors. These are not accredited investors. That means they're not millionaires yet. They're working to get there. They have some investment experience. They've looked at investment options before. They understand the investment opportunity. They don't need to live on the returns. And therefore, they qualify as a sophisticated investor in the eyes of the SEC. Now, most real estate syndications do not accept sophisticated investors, but we do. We accept sophisticated and accredited investors. And the process starts at peoplescapitalgroup.com to fill out a qualification form. But we really enjoy working with IRA investors. We also like how they like to make a difference in the local community, right? So when we're buying a mismanaged building in Newark, New Jersey, and we're improving that building, or Trenton, New Jersey, we're making it from maybe a slumlord owned it before into a nice place to live where people feel proud to live there. People like seeing their IRA make a difference in the community. So that's really what we focus on. And that's really important to IRA holders and any investors. So that's a fun perk of investing in our real estate. You might know these cities, Newark, Patterson, Trenton. You may have grown up around them. You might think, hey, I like the idea of improving one little area of that city. You know, sure, it's just one building, but hey, that's how cities are improved block by block. So people like that as we improve our little area of that city and our building and make it a nice place to live. And that's a real big benefit of self-directing your IRA into a real estate syndication that you don't quite see when invested in a mutual fund or something like that in the stock market. So that's it for tonight. I hope you enjoyed our presentation. You can learn more at peoplescapitalgroup.com. We only work with sophisticated and accredited investors. Our minimum investment amount is $30,000. And we do have more content on our websites. You can digest how we help people invest in real estate and how we've been doing it successfully for the last 10 years and why 90% of our investors do reinvest over time. And so that's all on our website, peoplescapitalgroup.com. So enjoy past webinars there as well. Our monthly webinars, our weekly blogs and podcasts, and then maybe come to one of our events in the office as well. But if you like what you see there, you want to learn more about how to get qualified, click the button, get qualified to invest. So I'll show you that right now, actually. We'll just quickly out of here. And it's a nice website. We put a lot of work into it. We've been able to actually really, through the years, just put a ton of content on there. So we get some good feedback. And we have an ebook. We have a video series as well. And so you can enjoy all that information, put your mouse over the value here, enjoy all that information. And then when you're ready to go, click qualify to invest. You fill out this form here, very basic form. That's going to allow you to then, we'll set up a call at that time. We'll reach out to you, set up a call, your discovery call to get started on your investment journey. We'll figure out your investment goals, see if they align with our goals on that discovery call, and see if you do qualify to invest with People's Capital Group. So that's it for tonight. Check out peoplescapitalgroup.com. Check out Next Generation and contact Jack to get in touch there to self-direct your IRA into real estate. And hopefully do team up with People's Capital Group here. We can build our wealth together for the future. Thank you so much for teaming up with us tonight and joining our webinar. We hope you enjoyed it. Have a good night.
Thank you.
Thanks, Jack. See you.